Um, but yeah, just before I hand over to you, just a little bit of housekeeping. So for everyone in the room at the moment, and I'll make mention of again, maybe once we're through the first section of the slide deck. But if you do have some questions, please pop them in the chat. We'll be picking out a few questions as we go along, and also at the end of the day, we'll have a bit of a Q&A section where I'll pick some of the more common questions that have been asked and maybe haven't been answered just yet. Other than that, maybe we'll move quickly to the disclaimer, James, being a very compliant financial advisor. Obviously, for everyone here, this is only factual information, so we haven't considered anyone's personal or even general circumstances. So it's just purely informational only. All the information today has been prepared by BlockByte and shouldn't be taken as advice or a recommendation either. So, James, I'll hand over to you, mate.
Great. Yeah, thanks very much. So hello, everybody on the call. So my name's James. We founded BlockByte in 2021. So we're a regulated digital asset investment and custody platform. So we help clients build long-term wealth in this new-ish asset class. Background is working at Monitor, Deloitte, and a host of major banks where we help them on revenue growth strategy, but also then going into a company called Stacks, where I led Australia's first company IPO to accept stablecoins as part of the capital raising process. And I'm joined by my business partner, Kim. So Kim, I'll let you do a quick intro.
Thanks, James. Hi, everyone. I'm Kim. Great to meet you all virtually. So I lead operations and investor relations at BlockByte. My background is in strategy consulting and M&A. Spent about 15 years of my career in-house and industry consulting roles. And then in the last 4.5 years in private equity investment management, managing investments for family offices, as well as helping James out with BlockByte.
Okay, so I'm just going to flip down the slide. That's me. Okay, yeah. So agenda for today, we'll run through the money problem. We'll then get into understanding what digital assets are. That's all right. We've just got a couple of people in the meeting room. Just let them in. Understanding what digital assets are. Looking at some of the investment and custody options when it comes to digital assets. We'll then also go through some of the key risks and frequently asked questions. And then we'll close up with key takeaways as well as time for a Q&A at the end. So anybody on the call, feel free to post your questions in the chat. And throughout each of these sections, Jayden will read out sort of the top 1 or 2 questions. We'll make sure that any other questions get answered at the end as well. So without further ado, purpose for today is basically these 3 things, which is understanding what the money problem is today, understanding what digital assets are, and what are the investment and custody options when it comes to digital assets. So the money problem. So money has actually changed over time. Many of you might be familiar with things called cowry shells. These were used like actually a couple of millennia ago, up until 200 years ago in parts of sub-Saharan Africa. These were a form of currency that people used to trade different goods that they had at the time. Obviously, it's not a great money. Like, it's not extremely durable. You can't hold it for 50 or 100 years without it cracking. They're not divisible. You kind of have to trade them one at a time. They're not uniform, so they're not always all the same, which makes them not ideal as a form of money. And also, they're not accepted everywhere you go, right? So they were never an ideal form of money. They're not super portable or stable in value either. We then had money evolve into things like gold coins, silver coins, a lot more durable in terms of the molecular makeup, not exactly divisible either. Yes, you can, have gold into smaller pieces. Gold is gold, so it is more uniform. But having said that, kings and queens of the days did sort of melt metals down and mix them with cheaper metals. So it's not perfect in that sense either. But generally gold is accepted everywhere you go, like in many countries around the world. A lot of people on the call will probably be aware that the gold price is up like more than 60% year to date. It's not extremely portable, but it is incredibly stable in value, and it's appreciated over hundreds of years incredibly well. Now, in 1971, we switched over to what's called the fiat currency standard. So effectively, President Nixon took the US dollar off of the gold standard at the time. And, prior to 1971, all of the countries around the world had effectively pegged their currencies to the US dollar. And what this meant is that if, another country wanted to redeem US dollars for gold, America would act as like the central bank for the entire world. And redeem a foreign currency for gold. However, in the 70s, as the US got involved in the Vietnam War, which was incredibly expensive, a lot of other countries started asking to redeem their US dollars for gold. And at that point in time, President Nixon decided to take the US dollar off of the gold standard because the redemptions were too high. And so the whole point of this slide is basically that the world we live in today, and the money problem in a nutshell, is really that the currencies that we all use and spend daily isn't really backed by anything. There's no finite supply, and so because of that, it can create certain problems, which we'll jump into now. So economists have commented on the money problem for centuries, actually, but very little has been done to fix it. So here's a very famous quote from John Maynard Keynes. So by a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. So what exactly does John mean? Well, if we take Australia as an example, CPI on average over the last 20 years, which is the rate of inflation for goods and services like gas, electricity, chocolate, just the things that you buy day to day, that's the most reported figure of inflation, and that goes up 2.7% per year. However, it doesn't track things like house prices, which we all know have gone up substantially more than 2.7% per year. It doesn't capture the value of assets going up. And so the more accurate measure for inflation is money supply growth. And that's been 8.6% per year on average over the last 20 years. And so that's a more accurate benchmark to use when we think about inflation. So why does it matter, and why is inflation a problem? Well, if you've got $1 million today and you think about this over 10, 25 or 50 years, even if you take the most conservative 2.7% assumption of CPI, over 10 years, if you're not investing that money or earning a yield on it, you're losing a quarter of the value. Over 25 years, you're losing half the value of the money. But again, that's taking the most conservative CPI at 2.7%. Realistically, if we take 8.6%, which is the rate of money supply growth in Australia, unless you're investing in assets, which hopefully we all are, you're losing up to 59% of your purchasing power over a decade, which is it's really shocking for most people. In Argentina, it's infinitely worse. So their inflation rate currently is about 193% per year. So over 10 years, they're losing almost 100% of the value of any currency, which is why Argentinians, as soon as they get paid, they'll invest that money straight away. They'll buy food, they'll buy long durable goods as soon as they can. So that's a quick introduction onto what the money problem is. The next, I'll just pause there, but the next section will actually get into understanding what's the relevance and what we're here for today to discuss, which is digital assets.
I think,
yep.
James, obviously a lot of us aren't economists here, and perhaps rather than just, unpacking what it actually means when we're saying we're losing money, a really relevant example for everyone may be, 2020, when that money supply really picked up. So COVID happened. Government started printing a heckload of money. It took a few years for us actually to feel, everyone called it, the cost of living crisis, where the inflation numbers skyrocketed to 7-8%. But at that point in time, that was just that inflation number for those basket of goods. So anyone, particularly those who lived, probably on the eastern states of Australia, while the cost of your grocery basket may have gone up by 8%, things that, is scarce assets, they would have gone up by about 20-25% in that same time frame, right? So if you weren't investing in those assets at that point in time, not only was life getting more expensive, but because of the fiat currency problem and the more money supply, if you weren't invested in assets as well, all those were also becoming more unattainable for people, right?
Spot on. Yeah, that's exactly the money problem in a nutshell. So spot on. If you're not if you are just holding on to cash and you think that's kind of traditionally we think of cash as, that's the safest investment there is. It's actually over time, it's almost the worst investment there is, just because it's guaranteed to lose purchasing power over time. So yeah, it's great for stable short term, but over long periods of time, over multi-year time horizons, it really does erode your purchasing power.
And just you might cover this a little bit further on in the webinar as well, but you mentioned Bitcoin, potentially being the next evolution of money.
Yep.
Do you see it as being a replacement to the dollar, or something more like a complement sitting alongside it? Because I'm also thinking about some of the clients we work with. They might be in retirement phase of life, and traditionally what people in retirement phase might do is run something called a bucketing strategy, where you do hold a little bit of cash to help meet your short-term lifestyle repayments or expenses, while the remainder of your funds or assets are invested. So for clients that are in that stage and might be looking at this money problem, they got large portions of money there, but they also needed to meet their expenses.
Yep.
How could Bitcoin work into someone's situation like that?
Yeah, it's a great question, and we definitely still need cash in the world that we live in today. Look, Bitcoin as it stands today is treated as an asset, and so that means that even if you wanted to use it as your day-to-day cash, it's more volatile than cash. Intraday, like it might be up 5% one day, down 10% the next day. Although the volatility has come down significantly, we don't see price swings quite to that extent these days. But it's not, I wouldn't say it's competing with cash. It's more competing with the S&P index. A lot of people compare it to gold. And
Yep.
obviously with Bitcoin and with it being treated as an asset, every time you sell it, you've got a taxable event there as well. Whereas obviously with cash, you don't.
Yeah, so although its properties are more akin to gold or currency, really as an asset class at the moment, it's got return characteristics that are more similar to equities. So, its level of expected return plus its volatility. So that's where we sort of see it in that basket.
Yeah, exactly. Yeah. Great. So we'll just jump into the next section, understanding what digital assets are. There's millions of digital assets. And so for a lot of people that are not, in the space all the time, it is quite a confusing space. And so there's been a few regulatory developments both in Australia and the US. And there's a simple way of understanding where things are heading from a definitional standpoint is you've got digital commodities, digital securities, and stablecoins. So what exactly are those and how do we differentiate them? Commodities, much like gold is a physical commodity, Bitcoin, Ethereum, Litecoin are digital commodities. And that means then they're assets that don't have a central issuer. What does that even mean? It means that there's no CEO or company of Bitcoin that can change the rules at the flip of a hat. It's very much just like an asset without a leader. There's no investment contract that people take when they buy Bitcoin or Ethereum. They're not signing a contract. They're not doing business with a company, and they're not expecting. They might be expecting profits, but there's no expectation of profits from a counterparty promising something. And then thirdly, and most importantly, is that these networks can run autonomously. And that means that if you try to, shut down a company or shut down, or, a good example is they tried to ban Bitcoin in China. They've banned it several times and unbanned it and then banned it again. Bitcoin doesn't really care. So it runs as an autonomous network, much like the internet. There's no single entity or company or individual that can just, shut it down. If we compare that to digital securities, so there's tokens like BNB, Kronos, OXB. These are tokens that major exchanges, so think of like Coinbase, if you've heard of them, or Binance, they'll issue their own tokens, and they'll do that to raise capital. So they do have a central issuer, and people do buy the token from a company expecting an increase in profit. But without those companies in the first place, those networks couldn't exist, and they wouldn't be able to continue to exist because they're controlled and dictated by a company that's effectively governing them. And then lastly, you've got stable coins. And so these are things like Tether, USDC. If you haven't heard of them, stable coins are probably the biggest, most frequent use case in digital assets right now. And it allows people to, send a dollar from one country to another without going through the banking system legally, but at much higher speed. So we're talking like seconds rather than days, and you're talking like fractions of a dollar to do so, or cents, as opposed to 1, 2, 3, 4, 5, 6% in some cases. So that's what a stablecoin is. They do have an issuer, but there's no expectation of a profit. So they're different from securities in that sense. And they also can't run autonomously. That's the easiest way of understanding what are the different types of assets in this space. Let me just change slide here. In terms of what are the actual use cases of digital assets, there's scarce store of value, which, the CEO of the world's largest asset manager, BlackRock, called Bitcoin a protection against irresponsible government spending because it's got that fixed supply. There's also 1.4 billion people around the world that don't have access to bank accounts. Like, in most developed countries, they're developing countries. They don't have, a branch where they can just walk into. So being able to access financial services on your smartphone, on a blockchain, is like a godsend to a lot of people. Another unique quality about digital assets is that you can self-custody them. You might have seen these little devices on the top right hand of your screen called ledgers. That's one example of them. And these ledgers allow you to password protect and hold, billions of dollars theoretically on a single device. And you could take that either device or a password in your head and then access the funds from wherever you want, anywhere in the world, without anybody knowing that you have them. So it's a unique feature about digital assets. There's also a thing called decentralized finance. So instead of going through a bank to take out a loan, there's now $77 billion of value locked in decentralized finance contracts, where some people are looking to earn an interest, so they'll deposit on platforms like Aave or Compound and earn interest. And then, depending on how many people want to borrow, they can, that will dictate the interest rate and the cost to borrow at on these platforms. A couple of other examples is tokenization. So we've mentioned stablecoins. That's the tokenization of currency. But there's also tokenization of real estate, where you can sell a factory, you could sell a house, and instead of looking for one buyer and waiting for 6 months maybe to sell your factory, you might be able to split that factory into 50 units and sell that to investors in all different parts of the world that want a slice of a factory and the property rights to it. And then, briefly we mentioned that settlement of payments is much faster on the blockchain. So it bypasses a lot of the traditional banking rails, which are much more slow and expensive. A couple of more slides on this, but what are the key trends, and how do we, how do we know this isn't just another speculative bubble? Like, a lot of people that are new to the space say, oh, isn't it like a tulip bubble? And these are good criticisms that have been addressed, for the last 10 plus years now. But just to give people some context, the digital asset sector today is worth over $6 trillion. There's 861 million confirmed users. I'm pretty sure this is well over 1 billion now globally. 17% of real estate sales in Dubai are now completed on the blockchain. And stablecoins, which we've mentioned a couple of times, just to give you an idea of scale, in the last 30 days, nearly $7 trillion of value is transacted through these stablecoins. But 83% of institutional investors plan to increase their digital asset holdings in 2025. And so you can see, like, this is not a pump and dump bubble. These are real, serious volumes of money moving through the space. Bitcoin being the largest at $3.4 trillion asset within the digital asset space. So I will just move on to the next one. This is a really useful slide. If you're thinking that, okay, yes, I've heard about Bitcoin and digital assets, but isn't it too late? I should have got in 5 years ago, 10 years ago. We'd all be, super rich if we had done so. Well, Yes, but if you look at even factoring in the recent growth, um, Bitcoin and all of the other digital assets combined are less than 0.4% of global financial assets today. So if you think that there's a potential that this sector is going to 1% of the value of financial assets in the world, just 1%, that's a 2.5x from here. And so we think it's going to go probabilistically more than 1%. You know, we don't like to put an exact number on it, but given that a lot of finance is moving onto the blockchain and into digital assets, we think that we're actually still very early. And this is part of a multi-decade trend that we're going to see over the course of our lifetimes. Last slide on this section before I hand over to Kim. This is, you know, a lot of people find regulation really boring. For me, this is one of the most interesting topics when it comes to digital assets. And the reason why is that in 2025, we saw the world, and this was led by the US, do a pivot really when it comes to how we were treating digital assets and how companies had to treat digital assets. So it started in January, where the FASB, which is the accounting standards board in the US, but a lot of other countries around the world follow FASB accounting principles, changed the rules so that instead of having to treat digital assets as a liability, or they couldn't mark the value up on a balance sheet, companies could now hold digital assets at fair value. What that means is that if a company buys $1 billion of Bitcoin, previously, if the price of Bitcoin dropped, they could only mark down the value of the asset, whereas now they can mark it back up again to fair value. There was also in February of this year, SARB 121, which was a bulletin put out by the main regulator in America, said that banks don't need to treat digital assets as liabilities on the balance sheet. Previously, they had to treat it as a liability, even though it is clearly an asset. We then got the Bitcoin Strategic Reserve announcement in March. So currently the US holds over 200,000 Bitcoin. That's the US government has 200,000 Bitcoin. And we saw a stablecoin bill enacted in July, and then followed in August by the US government starting now to publish its economic data through its partnership with Chainlink, which is another blockchain. And so we think the stage has been set in 2025 for institutional adoption over the decades to come. And so if you think that you're late or that you've missed the boat, we think that it's basically only from this year that institutions and large capital has been able to enter into this space. So I will hand over to Kim now, who's going to walk through some of the investment and custody options.
Just before you...
Oh, yeah, sorry, I'll pause.
Yeah, that's all right. One of the things that struck me is obviously if I'm someone in Argentina and I'm getting paid in Argentinian pesos that are deflating at a rate of 193% per annum, the obvious option for me, which you said, was to put that into an asset like Bitcoin, which hopefully is going to hold its value, or, even if you're more traditional, something like gold. That's a really obvious and clear use case, I think. But for someone in Australia where the inflation rate isn't maybe, obviously to that level, what sort of meaningful role could Bitcoin play, or other digital assets here in Australia where we don't have that inflation problem? What are the other use cases, I guess?
So I would push back a tiny bit and say that we do have an inflation problem still, but that it's probably underreported, and it's you only really see the inflation problem in hard assets like property, land, index funds and stocks. But I would say that Bitcoin's role, even within Australia, where yes, we do have lower inflation, is it's part of the portfolio. It's not, you don't go and take all your money and put the whole lot into Bitcoin. But if you've got a portfolio of stocks, bonds, some cash, you've got property, if you look at one of the recent reports by Van Eck, they show that, a 5% allocation to Bitcoin within a portfolio not only improves the returns, but because it's a different asset class and behaves quite differently to stocks, gold and bonds, that it actually improves diversification within the portfolio as well. So I think it's just more of it's a new part of the portfolio.
Yeah. And a lot of the other digital assets you did mention, even to myself, sound a little bit abstract.
Hmm.
Could you give any other real world examples where someone might already be using them without even realizing it? So I think you said, as an example, in Dubai, 17% of property transactions happen on the blockchain itself. There are other examples of that, but potentially in Australia where people are using this sort of technology and not even aware of it.
Yeah, it's a good question. So I would say not to the same extent. Like we've been slower from a regulatory standpoint in Australia.
Mm.
There's a company called Red Belly Network. They've rolled out tokenizing Australian government bonds, and they've already pushed like a couple of tens of millions through that, where people are actually buying Aussie government bonds now on the blockchain. But yeah, so in terms of other tokenized assets, it's still very, very early days. A lot of people are saying that for tokenized real estate sales and those kind of things happening on the blockchain, that's one of the more exciting opportunity sectors to sort of be building in now. But certainly, we're not seeing that on a mainstream basis. I think at the minute it's still very much viewing the asset class as an investment, and then there's use cases have evolved further in other countries. The biggest I guess like use case outside of the investment is definitely stablecoins, which we touched on. Tether, being the largest stablecoin issuer, they've got 500 million clients. 500 million. And so yeah, there's just like incredible growth.
Yep. Thanks. Kim.
Great. Thanks, guys. So we'll move on to investment and custody options. So how do you invest in crypto, right? What are your options? We think there are roughly 6 types of options, and we split them into direct and indirect. Direct is where you will own the underlying asset itself, versus indirect is where you're investing in vehicles that will give you exposure to the price action of that underlying asset, but you don't necessarily own the crypto itself. So in terms of direct options, I'll just walk through. So one option is mining. This is where you would buy a machine. For the example of Bitcoin in particular, you'd buy machines to mine Bitcoin, which is where the machines will validate transactions on the Bitcoin blockchain. And then in return for validating those transactions, you get rewarded in the token itself. So you get rewarded in Bitcoin per day. Probably the benefit of this is you get the daily yield, there's tax offsets from the cost of purchasing the machines, and you get this passive income. But unfortunately, for most investors, it's a pretty high setup cost, and it can be pretty difficult unless you have significant size and scale to get payback, because you're competing against multi-billion-dollar companies, right, that have got significant purchasing power, economies of scale. They own the underlying data centers, have costed free energy, and you're effectively competing against these guys that are like RS Energy is worth $25 billion. Marathon Digital, these are the 2-3 biggest companies in the world that mine Bitcoin. And yeah, so they will most likely, unless you have that size and scale, outperform. Another option, if you don't want to go down the mining route, which for most people probably isn't a viable option, is brokerage. So this is where you might go through a personalized broker to help you buy, trade, sell, and manage your portfolio. And so the benefit of this is that you can pick up the phone and you can talk to someone, for example, a BlockByte, on to get that in, read on the market what's happening, whether or not a trade might be suitable. Obviously, the drawback of this is that your broker may not be available at, say, 3 a.m. in the morning, right? So there are pros and cons to this. Another option for those investors who prefer to really do it themselves is to buy via an exchange. And so you may have heard of exchanges like Coinbase, Kraken, SwiftX, Independent Reserve. These are all retail exchanges. You create your account, create a wallet, and you can buy and trade and sell yourself. Probably one of the benefits of this is that you might get access to a wide variety of tokens. You might potentially have lower transaction fees, and some of these exchanges might advertise to have particularly low transaction fees. But the key thing to watch out for is it's not just the transaction fees, it's the spread. And most exchanges will not disclose their spread. And the spread is the margin that they'll take on top of that token when they buy that token off the wholesale market, right? So it's always good to compare the prices of different assets across different exchanges, then take into account the transaction fees to understand your real cost of purchasing if you're going to go via an exchange. The main drawback of buying via an exchange is that you can't, if you want to decide, hey, do I buy Ethereum today? You can't pick up the phone and call Coinbase. You can't pick up the phone and talk to someone at SwiftX and get a consultation to understand what's happening in the market. So it is more for people who want to be self-led in their investment journey. In terms of indirect purchasing options, there are a few, but the main three are ETFs, crypto companies, and managed funds. ETFs are exchange traded funds. You probably have heard of this vehicle, but effectively you're buying units in a fund that tracks the underlying asset price. So for example, BlackRock's IBIT ETF, the world's largest Bitcoin ETF, you own units in that IBIT ETF. But you don't actually own Bitcoin. And this is good if you just care about the price action and you want exposure to that. It's obviously easy to trade if you have any form of I guess a share trading account. You might be able to get access to that, and you don't have to go through the rigmarole of creating a wallet on the blockchain. Disadvantage of buying an ETF, and this also goes for crypto companies as well, is you're limited to the market hours. So if you're buying a Bitcoin ETF on the ASX, you're limited to Monday to Friday, 10 a.m. to 4 p.m. And so a real example of this is 2 weeks ago, we had a big like a drawdown in the market where the market dipped down roughly 10%, give or take, depending on token, some more, some less. And that was on the Saturday and the Sunday. And for example, at BlockByte anyway, we had clients who were able to buy on the Saturday night and get access to the crypto markets because they're open 24/7. You don't get that benefit of being able to trade 24/7 if you're buying an ETF. Crypto companies, you might choose to gain access to digital assets via buying shares in a company that owns digital assets itself. And so probably the most common example is MicroStrategy. It's Michael Saylor's company, and their main strategy is to buy and hold Bitcoin, and they aim to give investors a premium in terms of Bitcoin per share. The benefit of this is, you may get upside. It's a traditional format, and you get upside to other activities that the company may be doing to give you outside of just the underlying asset itself price appreciation. But some drawbacks might be it's a company, so it's run by a group of people. They may be doing things outside of crypto, and so it may not always necessarily be a direct exposure to the crypto asset. You need to consider all the other things that the company is doing. Last option, managed funds. This is where you might choose to invest in a fund that's professionally managed by an investment manager. They will pick and choose their own crypto assets, and maybe it's investing in companies with crypto holdings as well as investing in digital assets themselves. Obviously, the benefit of this is it's a diversified play. You're putting your trust in an investment manager to pick the assets that they believe is going to outperform their benchmark. And you've got a full-time professional team sort of working on that fund. Drawbacks can be high fees. So some of these funds will take, it's pretty standard to take a management fee. Some may take performance fees. And it's also illiquid. So some of these funds might have, say, I think it's common to have monthly redemptions, quarterly redemptions, right? So you might, if you say redeem at the end of the month, or you have to get 30 days notice period, redeems at the end of the next month, and then it might be another few weeks until you get your money back into your cash back into your account. So it's not as liquid as, say, directly investing in a digital asset itself or an ETF or shares. Great. So what metrics do you want to consider when you're investing or looking to invest in digital assets? Now, there are a lot of potential metrics that you could consider. And so for the sake of time, we've chosen three, which we think are good examples of three main metrics, not the only three that you could consider. The first is market capitalization. So this is the number of circulating tokens multiplied by the price, the market cap of the token. The reason that this is important is it gives you an indication of the economic size and value of the network itself. For example, there are millions of tokens and digital assets out there. Bitcoin itself is 60% of the entire crypto market itself in its market cap in itself. And so when you're comparing with, say, looking at another token, and that token might have 0.0001% of the market cap, which is pretty common, it should give you an indication of the level of risk that you're taking and the level of size and scale that token has. And unfortunately, most of the much smaller cap tokens that we see eventually go to zero or very close to zero and stay at zero, and it's rare for them to pick up again. The drawback of looking at market cap is you should also take into account realized cap, right? Market cap doesn't actually reflect the value that's gone into that token. It just reflects the price times the supply. It doesn't necessarily mean that people actually bought that amount. So you should think about realized capitalization, which is the actual amount of money that's been paid into or investors have bought into the network. And often if there's a big gap between market cap and the realized cap, that may give you an indication as to whether or not that token itself is overvalued. So daily active addresses, this is really useful to understand if there's the network itself is being used or if it's just, speculation. And daily active addresses is the number of unique wallet addresses that have had tokens move in and out in the last 24 hours. It shows you if there's active adoption, utility, projects being built on it, people trading on it. It's a good indicator of whether or not people are using that network. However, you've got to watch out for in terms of drawbacks, whether or not, what is that activity comprised of? Is it a lot of meme coin trading on a particular day? Is it automated bot trading? Is it the actual network itself doing some internal transactions to test things? It's just always worth looking underneath the hood to understand exactly where that activity has been driven from. The last metric I'll talk about is chain fees. So this, just like you would assess a company on the stock market, it's worth looking at the revenue that's generated by that network. And the reason why this is, again, important is it gives you an indication of the sustainability of that project or that token. And generally speaking, the fees are generated by transactions that are made on the network. And it obviously highlights its financial strength. A lot of tokens might do things called token buybacks, similar to how companies might do share buybacks. Tokens might use funds that they generate from transaction fees to buy back tokens on the network and therefore reduce the supply that's in circulation and therefore potentially possibly drive up the price. They might also use the fees to fund development on the project, on the network. However, obviously, revenue, you got to look at the growth rate. There might be particular spikes in some months, but it might drop off. So it's always worth looking at the trends over time to see if there's actually a sustainable long-term network or project. Great. So now that we've gone through some indicators, we've just put together some examples of the top 5 cryptos here and comparing some of those on-chain metrics, as well as some financial metrics. So on-chain metrics are metrics that you would track specifically to blockchain projects themselves. Obviously, we've got maximum supply. So I didn't talk about this previous slide, but this is really important because if it's got infinite supply, it's kind of like fiat currencies, right? Like if they're going to create more and more every year, then it might give you an indication that it might be difficult to hold its long-term value in that project. Obviously, Bitcoin's got a fixed hard supply of 21 million Bitcoins ever, of which we know that 19.9 million of those Bitcoin have already been released. There's only 1.1 million Bitcoin left to be released over the next 115 years. Ethereum and Solana, they can change their max supply. That's important to note. XRP's got fixed at 100 billion and Cardano is 45 billion. I won't go through all of the boxes here, but annual inflation rate is effectively the amount of extra supply that's being released every year. Also good to know. Daily active users, we talked about on the previous slide, how much activity and what addresses are active on a daily basis. Number of developers. This is really important because it gives you an indication as to whether or not there are projects being built on that network. A lot of the time, networks will release themselves and they'll say, we're great for these projects or these are use cases, but developers don't actually adopt it, then it doesn't give you much confidence that the token might be around for a while. So Ethereum's and Solana both got a really healthy sort of developer activity because there are lots of apps and other tokens being built on the networks. XRP, for example, has significantly less. Obviously, there are financial metrics. The historical performance is worth considering. Obviously, past performance is not indicative of future performance, but worth seeing how long that token's been around for, has it continued to perform. 5-year returns, obviously longer term performance as well. And then max drawdown. So what you might consider is the recent max drawdowns. Obviously, crypto is and has been more volatile than traditional investment vehicles like shares and bonds and that sort of thing. But you want to look at their max drawdown or the volatility over time and whether or not that's changed. So Bitcoin, for example, 5, 6+ years ago, it was common to see we saw max drawdowns 70, 80% in 1 year. Over the last 2 to 3 years, the max drawdowns for Bitcoin have been roughly 30%. And so the volatility has come down, and that has partly been driven by the institutional demand that's gone into the asset and propped up the price, provided a much more stable foundation for price. And you also get a law of large numbers, right? As the asset gets larger, it just becomes a little bit more stable. That's not to say that we may not see bigger drawdowns for Bitcoin, bigger than 30% in the future, but it just gives you an indication of the scale and stability of that project or that asset. And trading liquidity. So this gives you the indication as well as to liquidity or the buyers and sellers in the market that are actually trading that digital asset. And so you want to know that, because if it's got low liquidity, if you wanted to get out, it could be harder for you to get out, or you might be forced to sell at a lower price. So liquidity is a really important consideration.
Kim, there's obviously a fair few different ways that you can hold Bitcoin, which you mentioned earlier around, the investment and custody options. There's also a lot of different digital asset options to then invest in. What should someone start with first? Is it what they want to invest in, and then how do they access that investment, or should they think about it the other way around? Or, what's a sensible first step for someone to get exposure without going full crypto cowboy, I guess?
Do you want to answer this, James, or do you want me to answer?
Yeah, you go for it.
I'd probably say you would start with thinking about what you want to invest in, and then considering the vehicle that suits you best to gain exposure to that asset. So for most investors who are sort of starting new to the space, we would obviously not financial advice, but we would suggest starting with Bitcoin, right? It's the biggest, it's the most stable, it's got the most institutional support. It's being adopted by countries, institutions, sovereign wealth funds, endowment funds, wealth managers globally. And it's kind of we see it as a long-term buy and hold. And then outside of Bitcoin, they may, depending on the investor's risk tolerance, you may consider an allocation to other tokens in a smaller proportion of your portfolio, depending again on the individual investor. And then you go, right, what's your risk tolerance? Knowing it's going to be a long-term play. And then you decide, do you want to self-manage it? Well, we haven't gotten to custody options yet. Do you just care about the price? Do you care about owning the underlying asset? And one thing I didn't touch on before is if you own the underlying asset, the crypto asset, you can get tax benefits from if you you can shift the asset across jurisdictions. And some people may do this for tax reasons. If you buy ETFs or managed funds or crypto companies itself, you're sort of limited to the jurisdiction in which that asset is located. So if I'm buying on ETF on the ASX, I can't shift it to Singapore or Hong Kong or the US, right? But you can do that if you have crypto.
Yep. One follow-up question to that. Obviously, the popularity of index funds in equity and bond markets has exploded. They've been around 50 or 60 years, but, in the last 10 or 15, they've just gone bananas. Would Bitcoin be a fair representation of an index for, say, digital assets, or is it not really that simple?
James, you want to take this one?
Sure. It's definitely an index in the sense that, in buying Bitcoin, you're actually buying the majority of the market. But, an index being a perfectly representable slice of the entire market, Bitcoin is not. And so, when you're buying ETFs, I haven't seen one yet that's actually perfect market cap weighted. That's a good product idea. But effectively, you're buying individual assets with these ETFs, and there's a handful. There's Bitcoin ETFs, there's Ethereum ETFs. They're about to launch a Solana ETF and XRP ETF. But the US government's actually been shut down now for 3 weeks because they can't agree on a budget. But we are going to see a lot more of those ETFs across crypto come to market. And again, as Kim was saying, they're great ways to access digital assets. There's just trade-offs. So if you're wanting to own the underlying asset, then you'd buy, and hold the real thing. But if you're looking for price exposure only, then ETFs can be suitable. It just depends on what asset you're looking for, really, and what's available.
And I guess one other follow-up question to that too, it's been hotly debated in the equity markets for a period of time too, with the proliferation of index funds. But the markets as a whole are relatively perfectly priced, and all the information's available to all investors, and it's really hard to beat an index, I guess, over the long term. Do you think that's true of cryptocurrencies at the moment? Do you think there is an ability for someone to actively trade and beat, even using Bitcoin as a proxy, or a perfectly capitalized index fund?
Yes, really good question. So just from our observations over time, people that have tried, and again, there's always exceptions to the rule, right? But in general, we see if somebody's trying to trade their way, day trade their way, picking 50 different crypto coins because they're 50 cents today, and look, they could go to $10,000 tomorrow, so Bitcoin's already very expensive, I'm not going to touch it. Well, funnily enough, Bitcoin was very expensive 5 years ago, when it was like $11,000, and that was the lows in 2020. It's about 10x higher from the lows today, and so it's difficult, I would say, to outperform Bitcoin, but there are still opportunities to outperform it. I guess our approach and philosophy has been like hold the winning asset. So typically that means you probably don't want to be dabbling in token number 10,000 in the market cap size of things, because it's just got no volume, no liquidity, and highly volatile and likely not performing. But yeah, the quick answer is it's difficult to outperform the major cap tokens through crypto picking.
Yeah. All right. Thanks.
Yeah.
Sorry, Kim.
Oh, no worries. I would agree with that. And we have seen, without naming names, but there are lots of digital funds out there that will aim to outperform, and many of them that we've seen have not managed to outperform Bitcoin.
Mm-hmm.
So that's
I'll just close out this section here, and then we'll basically conclude the presentation and hopefully take a few more questions. This is one of the most important aspects to consider for people that are looking at entering into the digital asset space and investing for the first time. And that is like, how do you keep the assets safe once you've acquired them? And this is specifically like if you're owning the assets directly and not through a fund. So one option is what's called self-custody, and I showed a picture of it earlier, but that's where you might buy a device like a ledger or a cold card, and effectively that device, you'll have a password to access it, but that device holds what's called your private keys. And those digital private keys are the only access point to your crypto wallet. And so the benefit is that, if you self-custody, no exchange, no company, nobody else has access to your crypto. There's no chance, of another company losing your funds, which has happened in the past. But the downside, of course, is that, you lose that key or you forget your password, that's happened as well. It's a nightmare. And so there's risks with self-custody as well. And so there's another version of this, which is sort of, a safer form of custody. So that's called shared custody. Another term for it is multi-sig. And that's where you'd have, 3+ keys. And you might partner with a company. You always need a majority of keys to access your funds. So you might say, keep one at home, put one in a safety deposit box with a bank, give a third key to a company in the crypto space to work with. And even if you lose one of those keys, you've always got a company that has got the second key, unable to access the funds directly, but able to give you the additional key so that you've always got access. And so there's no single point of failure in the custody of the assets. For most of our clients, what we use, and this is the vast majority of people, and what we would recommend from a custody standpoint is managed custody. And that's where, you have a company that you invest in digital assets with, and then that company separately would have those assets held with an institutional grade custodian. So an example that we use at Fireblocks, an example that we use at BlockByte is Fireblocks. So Fireblocks have transacted over $10 trillion. They work with some of the largest exchanges and crypto businesses globally. They custody hundreds of billions in assets. And they've also got a insurance policy as well on those assets. So we think for most people, it's the simplest and easiest way to access really secure custody. It just means that you're working directly with a company. So for some people that really love the idea of being the only one responsible, they might look at options 1 and 2. But for 99% of people, I'd say managed custody is sort of the way to go. I will pause there. Actually, maybe I'll just jump onto the key takeaways, and then we can close out with a Q&A. So key takeaways are basically focusing on the fundamentals. So as Kim covered earlier, like looking at those key metrics and getting an understanding of what are those key metrics before you decide to invest in this asset class. Don't just take a tip from your mate and then put in all of your money into that token. Actually understand what you're buying. Understand the tokenomics, like how much does this token inflate every year, if at all. Is it owned by like a few number of wallets that have the majority of the coins? So if they decide to sell them, then they can completely destroy the price. And avoid meme tokens and stocks. So a lot of people like to buy Trump coin and Dogecoin, and it's fun for like 5 minutes, but then when you check your portfolio a month later, you're down like 90%. And I encourage everybody here to take a look at the Trump coin price chart over the last month. It's like straight line down basically. So yeah, focusing on the fundamentals. And then secondly, as we just covered, is prioritize custody. So understand if you want to self-custody or do a shared custody solution, like actually talk to somebody who understands how that works. Understand what managed custody is as well. So, as I mentioned, working with a Fireblocks, having somebody else manage it can be the safer option for a lot of people. And then just basics, like never give anybody access remotely to your computer, especially if it's not somebody you don't know. And if you do decide to self-custody, back up the devices, have several copies of your password and private keys. But never keep them online, never put them on your laptop. So those are just a couple of the basics. I've
got a quick, really good question from Jack. Just in relation to exchanges and whether exchanges actually hold the amount of crypto that are on offer, I guess, to all the customers they've got, or is it like a bank where if everyone drew at the same time, would they have enough to facilitate that?
It's such a good question. So unless they're a publicly listed company, they actually don't have to disclose what they hold and what they actually have available. And so in the case of a really famous exchange called FTX, another one was Celsius. They basically were lending out and investing client assets into a separate company, which they also owned, which was a hedge fund. And a few of their bets went badly. And so they lost client assets. And that was just a classic example of, because the regulation wasn't in place in the US, these companies were going overseas, they were registering in the Bahamas and trading from there, and there was no disclosure requirements. So it's a great question. And I think that is one of the key considerations. Like if you leave your funds on an exchange, one, are they a publicly listed company? Or two, if they're not, then does the exchange hold the assets directly, or do they have them with a qualified custodian, which is what we do at BlockByte. So yeah, it's a great question.
James, you've also touched earlier on regulation catching up. Do you think there will be like a particular moment in time where mainstream finally starts to trust this space a little bit more, or do you think it's going to just continue to be gradual? You mentioned 4 or 5 milestones already this year.
Mm.
Do you think there's one big event potentially on the horizon that's just going to be like, okay, this is it, this is safe and good to go?
I think largely those events are probably like 80% happened this year in terms of regulatory green light and the US government adopting a strategic Bitcoin reserve. So those were things that 5 years ago were, a pipe dream. But in terms of what's still to come and what's going to be massive is the Clarity Act out of the US. And that's basically categorizing all of the assets and services that sit within the crypto space. And that's going to give institutions even more confidence to, offer these as investment services, lending services within the crypto space as well. So, in 5 years' time, I suspect that whether you're in the US or in Australia, your banks will custody digital assets. You'll be able to buy digital assets through your bank as well. It's just that I think by the time we get to that point, we're going to be, I think, will be significantly higher in terms of market value. And so there has been a bit of arbitrage or opportunity in sort of moving ahead of, moving first before these large institutions have been able to feel comfortable moving in. But yeah, we're definitely moving in that direction. I was just going to just closing out just very quickly on what we do at BlockByte. So as I mentioned, we're Australian-owned digital asset investment and custody platform. We started in 2021, and our mission is really just helping support clients build wealth and economic freedom through safe and secure access to digital assets. We work with everyone from individuals, self-managed super funds, family offices, etc. We're not just another exchange. Like, we take the time with every client and provide a really personalized service. Take the time to answer your questions and make sure that clients understand what they're investing in and sort of navigating the space safely. So thank you very much, everybody, for your time. Is there any more questions? Any questions in the chat, Jayden, or happy to wrap it up?
I've probably used up all my allocation. So if anyone else has got any more, shoot them through the chat. If not, thanks very much, James and Kim. Trust everyone got a lot of value, a lot of education from today. If you are interested in, looking at this space more, obviously BlockByte do provide a service, and I'm sure James and Kim would be more than happy to, have an initial chat about getting either your journey started or just chatting about where you're at and how they could potentially help more.
Thanks. I think, Jeff, were you about to ask something, or?
Oh, I was just curious. Like, it seemed like this week there was something about the ATO. There was like a tax. They said that like holding assets and transferring it wasn't a tax event, so the ATO might have to reimburse all the tax they've taken off everyone for capital gains. I was just wondering if you guys had any insight into that as well.
No, I haven't. I haven't heard that. That is it confirmed, or they were just saying that they might have to?
Like confirmed by like someone speaking on social media. Like, I don't know. That's what I mean. Like, I saw a video of it, and it said that one of the judges essentially classified it as not a CGT event because it wasn't like an asset. It was a currency or whatever, and that.
Yeah.
I did read that a short while ago. Yeah, I think although I would love for that to be the case, I have my doubts of the ATO doing a mass refund. I still actually think, even though I don't want to, I kind of agree that at this stage, crypto is very much an investment asset. It's not day-to-day cash. And I doubt that the RBA is going to be willing to, make Bitcoin legally acceptable tender and sort of, kick the Aussie dollar to the side. So I hope that's the case, but I just see the ATO agreeing.
They probably just fight it just to not look stupid and lose $1 billion as well. Just exactly. But yeah, that makes sense. Cool. Thanks, guys. Appreciate it.
Thanks for the questions.
Thanks, Jeff.
Thanks, everybody.
Yep. Thanks, everyone. And James, we'll be able to send out a recording of this to those who did attend if they want to come back to anything. And for those that weren't able to jump on today as well.
Yep.
Awesome.
Good. Thanks, Jayden.
Thank you.
Thanks, everyone.
Thanks, everyone.
Cheers.
See ya. Bye.